In October last year, Ashish Gupta, the CIO of Axis Mutual Fund, wrote his report called Gamification of Equities, highlighting risks in the F&O space. And last Thursday, June 27th, SEBI announced setting up of a committee to review India's F&O equities F&O market. But this isn't the first time Ashish has been ahead of regulators and prodded them to take action. In 2013, he wrote his famous House of Debt report on the rising unrecognized NPAs in Indian banks. 2 years later, Reserve Bank did an asset quality review and ordered forcible cleanup of banks. So that explains why it is important for all of us to hear out Ashish Gupta, CIO and Head of Fixed Income at Axis Mutual Fund. Ashish, good morning and thank you very much indeed for joining us. Well, I have to start with the report a report of yours, which has fueled SEBI to take action. You wrote it in October. Is the F&O market worrying you even more now? And just generally explain the problem to us.
Sure. So, Lata, I think as I wrote in that report, we have seen very sharp growth in the F&O market and in particular the options market. And in many ways, the growth has been well ahead of what's been happening in the broader equity market and the cash market. And I must say that over the past few years, it's been a very visible trend that this time around regulators, and I'm talking about both RBI and SEBI, being much more ahead of the curve, being a lot more proactive, and really driving regulation in a counter-cyclical manner. Wherever regulators have witnessed surge in activity, whether it is on the market side or as you would have also seen, even for banking and finance, for example, in unsecured loans where they found the growth too hot, they've come out with steps to really curb the over-enthusiasm. And I think this is what gives longevity to the cycle. It brings in more confidence for investors that regulation is counter-cyclical. And that means we can be more confident for long-term growth.
Okay. Well, just a word more on this. So anyway, the committee will have to tell us and SEBI will have to tell us. Just a word, you spoke about the sachayization of, that is, you can participate with very little money. And you also spoke, if I remember right, about zero-day options, which means, people are not holding it for a week or a month. It's all half hour. You think that is the scope, that is what is worrying SEBI most?
Yeah, so I think both are linked. So really the sachetization of option or the drop in ticket size has happened because of increasing popularity of zero-day option. So if the option is going to expire the same day, the price of the option is very limited. The theoretical leverage for a trader in that to the notional value is 500 times to 1,000 times, right? So I think that is what really attracts people to trade these very actively. And I think really if the over-enthusiasm has to be curbed, it is in this segment in particular.
Okay. All right, I guess we'll have to invite you and probably somebody in SEBI after the report is out. I guess it will be put for public comments. We will know better at that time. Let me get to the other issue that may interest you, that is bound to interest you. Unsecured loans. Reserve Bank, as you pointed out, went on it by raising risk weights. Is the sector now safe, or would you worry about banks and NBFCs even now on the unsecured loan front, personal loan front?
Yeah. So, in fact, I'll say that even before the RBI took action on this front, there wasn't really a cause for huge concern. As you know, bank balance sheets are stronger, and even NBFC balance sheets are stronger than really any time in the last 25 years. Whether you look at trend in gross or net NPAs, you look at their capital adequacy, all are sounder than they have been before. And while unsecured loans have been growing rapidly, The 90-plus day delinquency levels were still very modest, and they were still a low single-digit number in terms of exposure for the total banking sector. So I think the regulator acted proactively before major stress builds up. And we have seen over the past 4-5 months bank lending both to for unsecured loans as well as to NBFCs, which was the other pocket where the RBI increased the risk weight, has moderated. Right. So in both these segments, we have seen moderation in growth already come through.
Okay. Okay. Well, just a quick word on MFI, and then I'll get to the bond inclusion. MFI is actually, yes, my colleague Abhishek put together a lot of companies which have clearly reported a rise in, the credit access, Grameen, that variety of small finance banks. And Ujjivan, of course, yes, alerted that credit cost has gone up. Will that, yes, any thoughts on that?
I think that is one segment, and even we have seen for some credit card companies delinquency level go up. And there are multiple states today where MFI delinquencies have gone up. But frankly, it is a business risk that is there in that segment. You do see higher cyclicality and higher loss rates. But you must also acknowledge that we are coming from a very low loss levels, and NPAs in this segment was sub 2%. Periodically, we do get to see 4-5% delinquency level on an overall portfolio basis. And within that, in some states, in some pockets, delinquency going even higher. And that is why it is very important, if you look at any NBFC and particularly MFI NBFC, that they have a broad-based and particularly geographically diversified loan portfolio. And most NBFCs, you would see, typically carry a leverage just around 4 times. So I think this is a business segment with a higher risk level, and you will see these cycles come through.
Okay, so not to worry too much, they are prepared. Let me now come to the big news that's hit the bond market, the bond inclusion. Actually, instead of the yields going down, yields actually went up on Friday, and they're higher even today at 7.02. Obviously, because of the telecom tariffs, is what bond dealers say. But in the long run, how are you looking at this flow of cash and therefore yields? Your opinion on fixed income market?
Sure. So, Lata, I think clearly the bond demand as well as supply dynamic is very, very favorable. And I think as much as we talk about really the incremental demand that will come in, estimates range from $20 to $30 billion because of this bond inclusion, it is equally important to note that supply of bonds is actually also very favorable. The fiscal deficit outlook is favorable. We have seen consistent increase in tax to GDP ratio over the last few years. Even in FY24, the final tax collections were actually better than the estimates. And today, at the end of the first quarter, you see the government is actually having an excess cash balance. In fact, that is something which is really keeping the liquidity tighter than ideally it should be. But the government finances are very stable, and that is really the most positive driver for the bond outlook. Even as we don't expect aggressive rate cuts this year, we believe, given the demand and supply dynamic, bond yields should ease. We would not be surprised if by the end of the year we are closer to 675 on the 10-year, despite having no real rate cuts. And I think there is consistent domestic demand for bonds. Plus, now we have this inflow coming from the bond infusion.
Okay. Well, I'm being warned on time, Ashish. Very quickly, do you think that corporate bonds are attractive or will become a very big market since insurance kitty and pension kitties are growing?
I think the challenge for corporate bonds and particularly non-financial sector bonds for us today is really supply of bonds. So we are not seeing as much bond raising from the non-financial sector, non-NBFC sector. So I think the demand side for corporate bonds is very, very strong. The challenge is the supply. I think as corporate leverage starts to go up, hopefully we should see more activity in the corporate bond market. But this time around, as of now, the challenge is more on supply of corporate bonds rather than demand for corporate bonds.
Fair point. Everyone's crying out for the capex cycle to start. Well, it's always inadequate time while speaking with you. Thank you very much, Ashish Gupta, for joining us. I think the clear word that Ashish is speaking about in terms of the quality of banks, NBFCs, despite these MFI kind of problems, is very important. Like I would say in Hindi, this is, Vashishta ke muh se Vishwamitra. It's a very big compliment if Ashish says that the system is clean. With that, we wrap up on Bazaar. Shortbusters coming up.